Hi everybody, this is replacement lecture. I think um, I have cancelled at least I think one or two lectures, but I forgot the date, and also we have cancelled lectures during the flood problem. So this is like the replacement lecture, and this is topic 8, liability and ownership equity. Remember in the previous lecture I have covered accounting for non-current asset, and then I have covered accounting for non-current asset, accounting for tangible non-current asset. So in that lecture, you have to focus on the way to how to record the purchase of non-current asset like plant, building, and equipment. So you have to know how to record that. And then the second thing is you have to know how to calculate depreciation, and also how to record depreciation. Other than that, they are important, but focus on the two that I have mentioned. Okay, this is the next thing in this course, which is topic 8, liability and ownership equity. Okay, let's see how to what is a liability, and then how to do recording for liability, and also after that things related to equity. Okay, let's see the liabilities first. Liability, so the simple definition for liability is the amount that a business has to pay in the future. Okay, that is the simple definition. So if you have a business, there is something that you have to pay in the future. That is a liability. Another simple definition for liability is obligations. Obligations that a business has to settle in the future. Same thing. If a business has to do something in the future, and then if the thing can be expressed in terms of dollar and cents, then that is a liability. The typical example of liability is the typical example of liability is account payable. Account payable is something like this. You have a business, you purchase something from supplier in credit. So that the amount that you have to pay in the future is supposed to be recorded as account payable. Let's say you have a small grocery shop, and then one day you purchase 100 let's say 200 kilograms of rice from supplier. Let's say the price of the 200 kilogram of rice is $1,000. So and then you purchase in credit. You promise to pay next month to the supplier. So that $1,000 has to be recorded as account payable. That is account payable. That is very typical liability. Another liability is bank loan. You have a business, you borrow cash from bank, let's say 10,000 or 20,000. So that is a liability, something that your business has to pay in the future. Okay, now we are focusing, this slide shows things related to current liabilities. See here, a current liability is an obligation that is, number one, due within 1 year of the date of a business balance sheet. This is the most important characteristic of a current liability. A current liability is a liability that a business has to settle within 1 year. If you see anything that a business has to pay within 1 year, that is called a current liability. And then number 2 will require the use of a current asset or will create another current liability. If a business operating cycle is longer than 1 year, current liabilities are those obligations due within the operating cycle. This second point says that the business has to pay the liability within 1 year. So basically, a current liability is an obligation or debts that a business has to pay within 1 year. The typical example of a current liability is the account payable. Most of the time, if you have a business, you purchase something on credit from suppliers, you will have to pay very quickly, within 1 month most of the time. So the account payable is a typical example of a current liability. Sometimes you have a business, another example of a current liability is like this. Sometimes you have a business, a shop, bank gives you an overdraft facility. Most of the time, overdraft is a current liability. You have to pay the debts, the short-term debt very quickly. Read about overdraft. I hope you understand what is overdraft. Okay, see the next point in this slide. Current liabilities are usually presented in the following order. And then the principal portion of notes payable that will become due within 1 year. Notes payable is a current liability. It is like short-term borrowing. A business use notes payable to make purchases. But as far as I know, in Malaysia, we do not use notes payable. This textbook is coming from US. So in US, they always use notes payable. But in Malaysia, we always use, as far as I know, we use account payable. But see here, point the next thing after the line about notes payable, account payable. So first you have to show notes payable, and then second the account payable, and then the next thing you have to show current liabilities like payroll tax payable, income tax payable, interest payable, and other accrued expenses. So this second point in this slide says current liabilities are usually presented in the balance sheet in the following order. Okay, when you prepare a balance sheet, you have to list all the current liabilities. So when you list the current liabilities, you have to list according to the time the current liability has to be paid. So most of the time, see here, the notes payable is the first in the list, because most of the time if a business has notes payable, the business has to pay the notes payable as quickly as possible. And then the second thing is account payable. That is the next thing after the notes payable. And then after that, there are several more current liabilities, like the examples that you have seen in the last line in this slide. Okay, see here more about the current liabilities. The parties who are owed the current liabilities are referred to creditors. So the situation is like this. Let's say you have a small grocery shop, and then one day you make a purchase from a supplier, and then the deal is you pay for the purchase next month. So in that situation, the supplier, we call the supplier creditors, because the supplier gives credit to your business. The supplier allows you to pay later, so allows your business to pay later. So in accounting, we call the supplier as creditors. If the creditors have a lien on company assets, they are known as secured creditors. The creditors without a lien are referred to as unsecured creditors. Okay, the situation is like this. Sometimes a creditor requests businesses to what they call this? How to say that? Request something. The creditor said, okay, we can give you credit if you give us something to hold. In case you cannot pay the credit, the supplier will take the thing that is given by the business that make the purchase. Let's say you have a small grocery shop and then you purchase something from your supplier. You want a credit facility. You ask for the supplier to pay next month. So the supplier asks you for something. Let's say the supplier said, the supplier asks you to give something, or to give promise to give something, and then if that is the situation, the credit term is called the creditor is called secured creditor. If the creditor just allow your business to purchase on credit, then that is called unsecured creditors. Okay, the second point in this slide is important. Common journal entries for account payable. Okay, this is the way to record account payable. So let's say A is to record a purchase on account from a supplier. Purchase on account means purchase in credit. You make the purchase today, you will pay later. So if that is the situation, so the way to record the transaction in the general journal is like the one that you can see in the slide. So let's say you have a small grocery shop. Today you make a purchase from a supplier, $1,000. You will pay the $1,000 next month. So how to record that? The way to record that is like the one that you can see in this slide. You have to write the date. Today, 14th of January, debit account purchases. The amount is 1,000. And then credit account payable. The amount is 1,000. Always remember, when you record a purchase, you have to debit the account purchase. Purchase is the opposite of sales. Remember, when you make sales, you credit account sales. Purchase is the opposite of sales. And then why you credit account payable? Because account payable is a liability. Liability increase, you credit. Okay, see here, the second record related to account payable is a record that you have to make when you make cash payment for the account payable. Let's say in the previous slide I said you purchase something from supplier, $1,000, you will pay later. So the next thing that will happen is, let's say after 2 weeks after the purchase transaction, your business has cash and then you pay the supplier. Let's say on 28th of January, your business pay $1,000 to the supplier. So how to record that payment? Okay, the way to record that payment can be seen in this slide. So first you have to write the date, and then you debit account payable. Why you debit account payable? Because when you make the payment to the supplier, your liability account payable decrease. When a liability decrease, you debit. Okay, that's why debit account payable, the amount in our example is 1000. So debit account payable 1000, and then credit cash 1000. Why you credit cash? Because when you make the payment, the asset cash of your business decrease. So asset decrease, you have to credit. So credit account cash 1000. And then the next thing about recording transactions related to account payable is to make cash payment with receiving discount from a supplier. Okay, sometimes if you make purchases on credit, the supplier will give you purchase discounts if you pay quickly. This is one way that the supplier can do to motivate people to pay quickly. So they offer a purchase discount. So if that is the situation, so the general transaction or record that has to be made is like the one that you can see in this slide. You have to write the date, and then you have to show the debit account payable to show that the liability has decreased. And the next thing is you have to credit discount received or purchase discount. Purchase discount you have to credit. It is the opposite of expense. If you pay more, it means an expense for your business. Now you get discount, so it is like revenue for your business. So that's why you credit when you receive discount from supplier, or we call it purchase discount or discount received. You have to credit the amount and then credit account cash. Okay, let's say the situation is like this from our example before. You in our example, you made a purchase to a supplier. The amount is 1000, and then you pay. After 2 days you pay. So when you pay earlier or quickly, the supplier gives you discount. Let's say he said, the supplier said, okay, they will give you 5% discount. So 5% is 50 ringgit. So you want to pay 1000, the amount that you owe to the supplier, but the supplier gives you 50 ringgit discount. So how to record that? So using the point C that you can see in this slide, the way to record that is like this. The date is, and you have to write the date, and then debit account payable. The account payable that you have recorded when you make the purchase is 1000. So debit account payable 1000. But the supplier gives you $50 discount. So how much you have to pay? How much is the cash out? The cash out is only 950. So after you have debited the account payable $1000, you have to credit account cash $950 only, because you got discount $50. But at the same time, you have to record the purchase discount or discount received. Credit discount received or purchase discount $50. So when you do the recording, debit, there is a $1000 record in the debit side, and in the credit side also there is a record of $1000. Cash out is $950 and the discount is $50. So in the credit side, there is a record of $1000, In the debit side also there is record of $1,000. Okay, like I said earlier, account payable is the typical current liability. So you have to know how to do journal entry or journal record for the account payable. Okay, this is long-term liabilities. Long-term liabilities. Long-term debt. Okay, long-term liabilities. Long-term liabilities is something like this. Okay, long-term an item is called long-term liability if the business has to pay in more than 1 year. More than 1 year. Let's say the typical example is you have a business, the business borrow cash from bank. Most of the time when a business borrow cash from bank, they will pay back the amount of the borrowing is big amount, is a big amount like 10,000, 20,000, 30,000, 100,000, 1 million. And also most of the time when a business makes a bank loan, the business will pay in the period of several years. That when the business has to pay the debt or liability in the period of several years, that debt or liability is categorized as long-term liability. Okay. Again, like I said earlier, this textbook is coming from US. They always use the term notes payable. But as far as I know, in Malaysia, we always record the thing as bank loan. So if the bank loan is a long-term bank loan, then we use the account long-term bank loan. Okay, so the way to record the bank loan, okay, like this. Let's say today you have a business. Today your business makes $20,000 borrowing from a bank. So how to record that? First, you have to write the date, and then you debit account cash. When your business borrow money from bank gives the cash to your business, or deposit the cash into your business bank account. So your asset cash, your business asset cash increases. So that's why when your business make a, let's say, $20,000 bank loan, you have to write the date, and then you have to debit account cash. For example, 20,000. And then at the same time, you have to credit account long-term bank loan. The same amount, 20,000. Cash increase, asset cash increase. At the same time, liability, the name of the liability is long-term bank loan, also increase, 20,000. In this white box, you can see the example is a business borrow from bank $10,000. So debit account cash, credit account notes payable or long-term bank loan 10,000. So that is the way to record that. Okay, let's say and then after 1 year, after 1 month, maybe in Malaysia we pay the bank loan every month. So after 1 month, your business pay $1,000 100. Okay, $1,000 100. So how to record that payment, $1,000 100? Let's say the 1,000 is the payment for the amount that you have borrowed, and then $100 is the interest. So if that is the situation, the way to do the record for the payment of the bank loan is like this. You write the date, and then you have to debit account long-term bank loan 1,000. Why you have to debit the account bank long-term bank loan 1,000? Because when you pay the loan, the liability bank loan decrease. Liability decrease, you have to debit. So debit long-term bank loan $1,000. The second entry is you have to record debit interest expense 100. The payment of the interest is an expense. In accounting, when you have to record an expense, it is always debit. You have to debit the account. So debit interest expense 100. And then you have to credit account cash because you make a payment. Credit account cash 1,100. Okay. Okay, that is the way to record long-term liability or long-term bank loan. Okay, this is also in US. They have mortgages. I don't think I want to explain about this. I think you have to know about bank loan, how to record the when a business make a bank loan, and then after that you have to know how to record when a business pay the bank loan. Okay, that two things I have explained in the previous slide. Okay, I think this one when it is involve the calculation of interest, I think this is not for you. This is for the for more advanced accounting courses. This is ACT3112. This is like the introduction to accounting, so don't have to do that. So leases. Remember, I think in the previous topic, in topic 7, you have also learned about leases. There are two types of leases, operating leases and capital leases. If you have a business, you make a capital lease, then you have to record it as a liability. You have to record the asset as your asset, and then at the same time you have to record the lease as a liability. So don't have to worry about this. Okay, that is about the accounting for asset. You have to focus on the two things. There are current asset and long-term. You have seen subtopics related to liabilities, current liabilities and long-term liabilities. Okay, so now you will see accounting for equity. What is equity? Remember, if you do not know what is equity, then you have to do revision again. Okay, in accounting we have three main elements in the financial statement. First is asset, and then second is liability, and then the third one is equity. Equity, the simple definition of equity is like this. Equity or owner's equity is the amount owned by the owner of the business in the business. So remember, in accounting, we have separate entity principle or assumption. The assumption or principle says that the business and the owner of the business are different entity. So the business is one party, the owner of the business is another. So when you do accounting record, you do accounting record for the business. So what is equity? Equity is the amount owned by the owner of the business in the business. Okay, let's see. Okay, these are differences between debt and equity. Okay. If a business has a debt, They say the business borrow money from bank, then the business is obligated to repay the debt. It is compulsory. But if a business receive cash from the owner of the business, the owner of the business put cash into the business or invested cash into the business does not have to pay back the amount. Okay. And then the second point here, you can see that for debt, lender does not share in the success of the company. If a business has debts or borrow money from somebody, then the business is making profit. The business does not have to share the profit with the lenders, with the party that gives the debt. But things related to equity is like this. Remember, equity is the amount that the owner of the business invested in the business. So if the business is making profit, the business has to share the profit with the owner of the business. Okay, that is the difference. So investor or the owner of the business has shares in the success or profitability made by a business. Okay, just to refresh your memory, there are three main types of businesses in terms of ownership. If a business is a sole proprietorship business, the business is owned only by one person. So that one person is the person who will invest cash or other assets into the business. If the business is making profit, then all the profits will go to the pocket of the single owner. Okay, that is a sole proprietorship. But if for a partnership business is a business owned by several owners. So the equity is the amount contributed by the owners of the partnership. The owners of the partnership is called partners. If the partnership business makes profit, then the profit belongs to the partners who have invested in the business. And then another type of business according to ownership is company or corporation. A company is a business owned by shareholders. Companies most of the time they are big businesses like Alibaba, Petronas, AirAsia. They are companies. And then these companies are owned by shareholders. The number of shareholders are huge, maybe thousands of people, unlimited number of people can own a company, particularly a public listed company. A private limited company is a smaller company and can be owned by limited number of people. Okay. So just remember, corporation is owned by shareholders, so don't have to worry about that. So shareholders, they purchase stock of the company. When they purchase stock or shares of the company, they become one of the owner of the company. You can do that also if you have cash. In Malaysia, you can open an account in, I can't remember the name of the organization, and then you appoint a stockbroker or stock dealer, and then you can purchase shares of any companies listed in Malaysia using an online platform. As far as I know, in Malaysia, when you want to purchase shares of a company, the minimum number is 100 unit, 100 shares. So it is called one lot. If you, let's say you have extra cash, you are interested to purchase Petronas shares. Petronas is a Malaysian company, so you are interested to purchase Petronas shares. So you have to purchase, the minimum is one lot. One lot contains 100 unit of Petronas shares. So if the cost is like $1,000 or $1,500, I'm not sure, then you have to pay that amount, then you will get the shares almost in an instant, using an online platform. There are several type of shares, but you don't have to worry about that, because in this course, in this ACT3112, you are learning about how to do accounting record for a sole proprietorship business. So don't have to worry about that. Okay, here is the way to do accounting record related to the equity, and this is specifically for sole proprietorship business. Okay, let's see. The first journal entries that you have to know is how to record when the owner of the business invests an asset into the business. So let's say the situation is that you have a small grocery shop. After several months of operation, you think that your shop need extra cash. So you take your take your own cash, $5,000, and today you put the $5,000 into the business. You invested $5,000 into the business. So how to record that? So the way to do the recording is like the one that you can see in this slide, part A, point A. So when the owner of the business invested something into the business, so the first thing that you have to do is to write the date and then debit cash if the owner of the business invested cash. Our example is the owner of the business invested 5,000 ringgit or $5,000 into the business, so debit cash $5,000. Why you debit cash? Because when the owner of the business put cash into the business, the business cash, the cash owned by the business, increases. $5,000. Cash is an asset, so asset cash increases, you debit. So debit account cash $5,000. And then credit account capital $1,000. Capital, if you refer to the rule of debit and credit, when there is an increase in capital, you have to credit the account capital. Investment by the owner of the business can be done using cash or other asset. Other asset is like this. Let's say you have a small business, a grocery shop, and then after several months of operation, you think that your business need a personal computer. So you, as the owner of the business, you don't want to purchase a new computer or PC for your business, but you think that you can take your own PC from home and put into the business. So you can do that. That is also a form of investment by the owner of the business into the business. So you take PC from home, maybe the cost is $2,000, you put into the business. So how to record that? So to record that, you have to debit account equipment, personal computer $2,000, and then credit account capital $2,000. Okay, and then B, the next thing is one more thing related to equity is the owner of the business also can take something from the business. Let's say you have a grocery shop. You have run the business for many years or many months, and then one day you think that you need cash urgently, so you go to your shop and you take $200 cash from the cash register because you have to pay something urgently. So that situation in accounting we call it withdrawal. That situation is the owner of the business takes something, take an asset from the business. So if that is the situation, the owner of the business take $200 from the business. So how to record that? So the way to record that is like the one that you can see in the B point here in this slide. First, you have to write the date, and then you have to debit account drawings or withdrawal. In our example, it is $200 cash. So debit drawing $200, credit account cash $200. The owner of the business also can take other assets from the business. Let's say in other situation, you have a grocery shop. So one day you take 20 kilogram of rice from your shop because you need rice at your home. So you take 20 kilogram of rice. The value is $50 from your shop. So that is also a withdrawal. How to record that? So the way to record that is you write the date and then debit account withdrawal $50, credit account inventories $50. Okay, because you take inventories. Inventories is an asset. You take price from your shop, you have taken an asset. If you take furniture from your shop, so maybe you have a grocery shop and after several years there is one table that is not used anymore in your shop. So you want to take it and put the table at home. So you take the furniture. So how to record that? Debit drawing and then credit furniture. Okay, that's it. That's all for topic. This topic about accounting for liabilities and equity. Thank you very much. Do not forget to write your name and metric number in the comment section of this video. I will record that as the lecture attendance.